let's really talk about where this started from. This pandemic, this virus, it really led to initially a very big hit on the stock market. So people that own stocks and mutual funds, that was where we really saw the first big financial hit. And so what happened? People got concerned. There wasn't a lot of concern. And overnight, within a matter of weeks, we had the stock markets really in a big free fall. They fell a lot. In fact, the big indexes, NASDAQ and S&P and the Dow, they went into bear territory. So I think the drop was right around 30%, give or take. Last I checked today, the market is kind of flat. It was down about 18 points, but really just kind of flat on today's data. So what we had is the stock market really reflects projections about the future. It's how investors feel things are going to be in the future with earnings, corporate profits, the economy. And obviously, with this virus going around and the impact, what it's done to so many economies around the world, starting in China, then seeing it just wreak havoc on Italy, and then what it's done to us. Unfortunately, the United States now is number one with the infections with this, which is really unfortunate. So a lot of the stock market decline were fears about the future, that we were going to drop into a recession, then a severe recession. And frankly, we're right in the middle of what's going on. And what it did is it led to some panic selling. And in fact, we had some natural circuit breakers that are built into the stock market that actually were activated, where we'd have a pause of 15 minutes to let everybody catch their breath, try and have, just a little bit of sanity into a challenging situation. So unfortunately, this is where things started with the stock market. And what it does is it really hurts everybody's confidence. Whether you're an investor in the stock market or whether you've got 401k or your IRA tied up for your long-term planning, having that big of a decline is really something that's challenging. One question that came up, and Elise, if you can help out with this, is there a link where we can download the presentation? If you could create a PDF and post that before the end, that would be wonderful, Lisa. So that's what we've got. Well, let's look at the real estate side of it. And what I'm going to talk about a lot on this presentation is kind of looking back to things that we know. So you can see we've had other historical events. We've had other things, swine flu, H1N1, other coronaviruses, and we can look at what happened with those and what was the impact on the economy and what was the impact on the real estate market. But we can also look at past recessions. How long did it take for real estate to recover? Now, you can look at the last two bullet points. Right now, Goldman Sachs, they are forecasting a very sharp recession with the GDP sinking to down 24%. And that's after a decline of 6% in just the first quarter of this year. So that's a really significant, steep downturn. Many economists are looking that we might be getting a little bit better in quarter three, could be fourth quarter. Nobody really knows for sure. So what I want to start off with, let's talk about the interaction with real estate. When we look at the real estate market nationally, it tends to be fairly stable, even with factors like a recession. So in the last 5 official recessions, going all the way back to 1980, so going back 40 years, there have been 5 recessions. One was very big, the Great Recession in 2008. And you're going to see me later on compare and contrast where we were in 2008 with where I believe we are economically today. And then I'll look at another downturn, kind of the dot-com 9/11 downturn, and really look at some of the data that's out to see how strong are the real estate markets, how strong are balance sheets for banks, for corporations, for individuals. In all of these, when we look at the very first month before the recession to the final month, prices fell about 2.7%. So they went down, but that's not really statistically a really big downturn in pricing at all. So that's something just to keep in mind. I think it's important as we're right in the midst of this with, the layoffs and the pullback and everything that's going on right now to take a longer range view. So local real estate markets could potentially act, a property, whether it's commercial, residential, as an attractive counterbalance. So if you look at it historically, Real estate as an asset class is typically been what's called a non-correlated asset compared to the stock market, meaning it doesn't move in tandem with the stock market. And that provides for most investors a nice counterbalance, right? It provides some diversification and it's helpful for that. So there are quite a few people, myself included, that think with the downturn in stocks, there are a lot of investors that may have had all their eggs in one basket, had all their money tied up in the stock market, that might be looking to diversify and get into real estate. Typically speaking, you could have on the residential level those that were higher earners that maybe have seen their income cut back, laid off, and their real estate and their stock portfolio hammered. They may not be in the financial position to trade up to that ultimate dream home, those luxury homes. So, on the high end, I think it's realistic to think that luxury residential real estate is probably not going to see as much demand until the economy begins to recover. That's something that's realistic. Now, when we look at the market, and so the title of this was the national real estate market. And let me share something. The head economist for Stewart Title, Dr. Ted Jones, he has a saying that he says often, which is, there is no such thing as a national real estate market, meaning real estate is always local. It's going to come down to a local market and the local economy and job growth and all the variables that are taking place locally. So we're looking at a broad brushstroke, but there are going to be pockets. Certainly right now, I think it's realistic that some parts of the market where there was a lot of appreciation, places like San Francisco Bay Area, Seattle, Washington, San Diego, California. I'm speaking to you from just south of Denver, Colorado, another market that really shot up. Those areas might have potentially a little more risk of a pullback because they shot up so much, but it's going to be variable. When we look at this on the market, I think right now we're dealing with a fear variable where we've got fewer people that want to list their properties. We've got fewer buyers, uncertain about the future. So it's fear and uncertainty that's really driving things. The very last bullet point is a really important one to consider. Getting financing. Everything really blew up within the last few weeks on that particular thing. The capital markets are not functioning like they normally do. So we have seen, as a 1031 exchange qualified intermediary, we've seen deals fall apart because the buyer can't get financing. Very, very challenging. In fact, there are certain segments of the marketplace where it's almost impossible to get financing for certain types of purchases. Very, very tricky, and the lenders are struggling with all these different shocks that have come. So the ability to access capital at attractive rates, which has been really good right up to this COVID virus situation, that has changed, and it's making things very, very challenging. But when we look at this big picture, we've got very challenging and turbulent times. I mean, we're all watching the news, and we see all the bad news coming in all the time. There are a lot of shocks that are going on, and you at the same time have long-term investors that can be looking towards the long term. And you know what they do? They smell opportunity. There's a little bit of blood in the water in certain areas, and people that have cash, I mean, that's the most important thing. Cash is king in the real estate industry. It gives you the ability to execute on a purchase that somebody else can't, to take advantage of a downturn or a down market, scoop up assets at favorable prices. So right now, I think the investors that have the cash that were on the sidelines, they can take advantage of any price reductions. And if as long as they can qualify for financing, they can take advantage of some really good rates. Now, let me switch over just to the residential side and give you a snapshot of what's going on. When we look at residential real estate, we had just recently, median home prices hit a record high. In fact, January sales, residential prices were up 7% year over year from January of 2019 to 2020. And the sales volume was also up. So very strong residential market nationally. When we look at rents going up, they've increased 36% over the past decade. So at the end of the day, we've had a lot of run up in home prices, and they've actually increased higher than rents in most major cities in the country. And the next bullet point is a really important one. The number of renters, those that rent apartments and homes, things like that, went over 100 million this past decade. So we're now roughly a third of America rents, which is going to create a lot of demand for that space. So the renter population is growing. In fact, home ownership statistically has been dropping year after year. And you can look at that from a societal standpoint. I think there's benefit to people being able to afford homes and invest in their community. As a investment property owner, it does provide a very nice trend because there are more and more renters. Now, I wanted to share with you just on the residential level, when we look at rents, they've increased a lot. If you go back all the way to 2007, they were at the high 800s. And then you can see year after year, they've steadily ticked up. So now the average rent's just under $1,100. So we're seeing rents go up. And that's even in down markets. And some of that are supply and demand type forces that have really driven that. That's what's going on in the marketplace. Well, what happens right now, and we've got this unique time window where we've got tenants in buildings renting homes and apartments and multifamily, and what are they going to do if they're not going to pay the rent right now in the short term? Because a lot of them don't necessarily have to, related to the COVID-19 virus. It's going to put property owners in a crunch. And quite frankly, at the end of the day, that's going to work its way down the food chain, which is going to put financial institutions and banks in a crunch. If they're not going to be getting full mortgage payments, they still have to go ahead and pay the investors that have purchased their investment products. So when last time we went through a downturn, what happened was the administration, back then the Obama administration, they really had a huge bailout for investment firms, large financial institutions, and banks. And individual property owners, they didn't get a bailout. They needed to do that to keep the system working. They needed to have the capitalization. The financial institutions were very low, and so they needed that. But the individual investor didn't get it. Well, today, many more of the loans have been made to more qualified people. In fact, yesterday they just some of the larger banks just bumped up the credit score that they're going to require. So good credit scores, good financials, good reserves. What I'll share with you, kind of a theme, and you'll see me expand upon this. I think that the downturn that we saw in 2008 that led to the Great Recession is nothing like what we're facing right now in 2020. And that's just my opinion. So let's walk through some of the segments. What's being hit right now? Certainly hospitality and hotels, they're vacant or almost close to vacant. Nobody's filling them up. And that's from business travel, which is ground to a halt, and also vacation travel. So that particular niche is really dried up almost completely. Nobody's doing business travel, leisure travel. The next one, the office sector. Office properties, when people go to release, I suspect that not only will they have less staff, because right now corporations are cutting back and they're letting people go, they're reducing salaries, things of that nature. So we might have fewer people employed. But we've also got a fundamental change. This virus has created a situation where I think going forward, you're not going to have as much need for large office space. Companies aren't going to want to carry the overhead, and they're going to find that some of their employees maybe prefer working out of a home office situation, and they're set up that way. The next one's pretty obvious. Shopping centers, retail, strip malls, all of those things. Boy, what a fundamental change. People that weren't even doing a lot with online shopping have now been forced to do that. And that's going to be a permanent change. And so those areas are going to be, I think, really feeling a lot of pressure. People that are sheltering at home, which is really most of the country, that's affected the whole tourism industry. And here's a byproduct of that. Sitting here in the middle of April, most people start making their summer vacation plans. In fact, I had rented a condo for the weekend up in the mountains in Keystone, Colorado, and there's a festival. I take my kids. We've gone to it, a bacon and bourbon festival, a lot of fun. They canceled it, obviously related to COVID-19. So I've now canceled my reservation. You have a lot of property owners that are not sure about their summer plans. What are they going to do? Well, one of the impacts that this might have, and I think is probably fairly realistic, is we've seen a significant increase in the appreciation of second homes and vacation home markets. So I'm in the Rocky Mountains, a lot of areas there where people vacation, but all over the country, there are vacation and second home markets. If you're in Minnesota or Wisconsin, lots of lakes, the coasts have beaches, Arizona golf courses, you name it. I think those areas, if somebody did not purchase that property for cash and they were counting on peak rental income, which typically comes in the summer and maybe during some peak times if a winter resort in the wintertime, they may not get any of that income, which means they're not going to be able to service the debt, which means those prices are going to slip. So that's something to keep in mind. So long-term property owners with long-term tenants, I don't think they've got as much of a hit. They're not as much of a risk. But what you've got to do is you got to realize we're all going to have to make concessions as property owners because the tenant really is such an important part of keeping that cash flow coming. Multifamily and single family homes, people rent for a reason. They rent because they haven't saved up enough for a down payment. So that whole particular group of people, that segment, they probably don't have a lot of savings. I think that's pretty well known. So when something like this happens and they lose their job working at a restaurant or something like that, they don't have much to tap into to go turn around then and pay the rent that's owed on the property. Now we've got a very unusual situation where now we've got county courts that are closed. We've got moratoriums where we can't evict people. We can't turn people over. Normally, if I have a tenant and they're not paying, I can go through the eviction process and within a matter of months, turn over that unit and then get a new paying tenant. That's not possible. Same with late fees and penalties. So there is a big concern right now that investment property owners are going to be forced to carry that burden that they're in the middle. They've got to make a payment to their lender in most cases. They've also got all the operating costs. Those don't go away. And sometimes people forget that. Property taxes, they still have to be paid. The insurance costs have to be paid. Maintenance and upkeep. If something goes out in a unit or property goes out, they have to fix it. So an investment property owner has certain fixed costs that don't go away, even if they're not receiving the rental income. We all probably read about the fact that some lenders, Fannie Mae, Freddie Mac, they're offering forbearance, but I can tell you not all lenders are, and certainly on commercial, they're not necessarily doing that. So some might have some flexibility and be willing to do that, but others are not. And so that's putting a real big financial stress, not only on the tenants themselves, but also on the property owner who doesn't have as much cash flow coming in to service all the operating costs of owning a property. So that's a real big challenge. Now, something that's probably fairly obvious here is when you look at this, you've got a long-term situation where people are losing their jobs. Rents may not go up, although I will share with you the counterbalance of that is they may actually go up as well. Sometimes rents do go up if we've got people that are losing their houses. I think residential real estate fundamentally is probably going to weather this a little bit better than the commercial market. People need to live somewhere. They need to live in a home or they need to live in a rental property of some sort. So they're going to have a place to live or they're going to have a demand for a place to live. Here's an important concept to keep in mind. We always talk about rental property and buildings and the cash flow. At the end of the day, it isn't actually the property that is the asset. I mean, I know we carry it on our balance sheets as an asset. It's not. It's the tenant in the property that is really the asset. So you want to make sure that you've got tenants that are paying. Many of you probably heard you had the Cheesecake Factory a few weeks ago came out and said they would not be paying rent on their properties in April. They weren't going to do that. So that's an example of a commercial tenant that's not paying rent. And that certainly is happening at the residential level. I saw a study just a couple days ago. Rents are off. They're not as bad in April. Rent collections are not as bad. I think the one study I saw is they were off maybe about 12% from normal rents. So they're down, but it's not a situation where half the tenants aren't. Some are not because they can't. Some might be taking advantage of the situation. So at the end of the day, what do we need to do? Investment property owners need to reach out to their tenant, whether it's a commercial or residential tenant. Make plans, trying to agree to a payment plan, something like that. In my opinion, it's much better and it's healthier for everybody to get some rental income coming in versus none. Reduced rental income can help offset all those hard costs versus not having anything coming in. And it's just a real important time for everybody to work together. Now, let's look at where we were prior to this COVID-19 outbreak. We have very, very strong fundamentals. And this is, I think, the important concept for everyone to take away. It's April 16th. We got to look at what is the market going to be like 6 months from now, not right where we see it now. Right now, it's just awful. There's just carnage everywhere. The economy was very, very strong. unemployment was very, very low, under 4%, and unemployment was low for a lot of different segments. So it was very, very positive. Gross domestic product up around 3-4%. We had a decade of economic growth, and we had the longest running bull market in history. The other advantage that we have is that quality real estate in the United States, and this is particularly on the commercial side, it's really seen as a safe haven internationally. So when there are times of distress, real estate in the U.S. is very, very attractive. So we've already talked about some of the areas of shocks, hospitality, student housing. I'm sitting there in a home with two kids home from college. Both of them are doing everything online. One kid's going to get a refund, one is not from the particular university. So those are some temporary shocks. Businesses that'll do well, essential businesses, grocery stores, drugstores, things like that, they're doing very, very well. And certainly a lot of industrial assets are probably going to benefit from the move over to added e-commerce, whether it's Amazon or all the other services. The fact is the way we shop and get goods is fundamentally changing. We still need the capacity to store things. So industrial, excellent. But maybe how it's delivered will be different. We're not going to go down to our local store. Maybe it's delivered via UPS or FedEx or the friendly Amazon truck. So quality real estate really remains in demand. A unique situation, we had a spread between the 10-year Treasury and the average cap rates were at a 30-year low. Investors can really take advantage of this marketplace. Now let's get into what's going on. Right now, interest rates are at historic lows. If you get the financing, they're at historic lows overall. I know there's been a little bump up on the residential side, and that's due to some things where banks will short the market. They kind of hedge their bets when they make loans. But let's look at what's happened. Federal Reserve now has essentially cut the interest rate to zero or almost zero. So March 3rd, we had a little interest rate cut. March 13th, an additional one. And then look what the Federal Reserve did. And this is really important. The big difference between this downturn and other downturns is the federal government and the Federal Reserve very actively engaged and doing a lot of proactive measures to try and get liquidity, to try and get money injected into the system, to businesses, to taxpayers, to everybody. So Federal Reserve commits to repurchase agreements. They do additional quantitative easing. The Federal Reserve reduces the reserve ratio at banks very low so they can lend out more money. Then next, we've got the stimulus plan from just a few weeks ago, the largest federal stimulus in history. Now, on the back end, we're going to have to pay the piper on that somewhere. There'll be a cost to that. But the government came together, both Republicans and Democrats, and said, we need to help Americans. And we got a lot of money out into the system to businesses with loans, to taxpayers. And so they really came through very well in getting money to the front lines. And I won't go through all these different programs. So you can see April 9th, we had an additional injection of money into the system by the Federal Reserve. So the theme here, both the federal government and the Federal Reserve are working together to get a lot of capital to businesses, to business owners in different ways and different vehicles. Now, one minor observation that I just want to point out to you, when you put this much money in, trillions and trillions and trillions of dollars, and that's a lot of money, eventually it's going to lead to inflation as that gets into the system. So you just keep in mind that will happen later on. And I think everybody knows that. Real estate typically has been a very good store of value in an inflationary environment. It doesn't typically track better than inflation, but it tends to keep up with inflation. So the purchasing power stays there. By the way, when you think of inflation, we all tend to think of the run-up of prices, the prices go up. It's really the opposite of that. Inflation is really the purchasing power for that dollar goes down. There are more dollars chasing the same amount of goods and services. So the prices are going to go up to reflect that. So that's just a term to keep in mind. I'm not going to go through all the details on the different downturns, but just look at the last two. 9/11 and the dot-com crash, that was an 8-month duration. Compare that to the Great Recession, where we had 18 months on that. What I think we're seeing here, in my opinion, and I don't have a crystal ball, but in my opinion, What we're seeing here is we're seeing something that is very similar to the 9/11 and dot-com crash, not like the Great Recession. And I'm going to give you some data right now to kind of support that. Let's look at the past 18 years. Core retail sales up 44% over the last 18 years. Median household income up 23%. And look at the next figures. In 2001, household debt was at 73%. It went up dramatically. In 2008, it was at 98%. But now, back in 2019, we're back down to 75%. So we're 23% better than we were way back in 2008. And to me, it's very, very similar to exactly where we were in 2001. Let's look at things on the commercial real estate side of things. Vacancy in the early 2000s, 9%. Last year, 6%. But we were down. Vacancy was down. LTV, the loan to value on commercial assets, was at 69% back in 2004. In 2019, it's only 62%. So we've got better structure there on commercial assets. When we look at the single net lease segment, you can see some of the different cap rates. First quarter this year for retail was just over 6.15%. Office cap rates, 7%. Industrial cap rates, just over 7%. But the next bullet point is the relevant factor. Net lease transactions in 2019 were up 35% from 2018. And 2018 was a good year. So fundamentally, that part of the marketplace, very, very strong. And one of the reasons I bring this up, this asset class is a very popular one for not only private investors, but also for people that are doing 1031 exchanges. So here's what we got. The big picture, commercial real estate, the economic fundamentals just 2 months ago were very, very strong. So we're definitely facing some challenges on the health standpoint where we're all sheltering at home. And that's spun off now into economic problems, right? Employment, jobs, factories being idle, things of that nature. We seem to be doing very well at that whole reducing the spread. That seems to be finally have turned the corner in the last week. You hear that term, that flattening that curve. That seems to have happened. And we're now not quite as concerned about overwhelming our medical facilities with all of those types of things. That was a big concern. Switching gears, look at this. Banks and financial institutions, reserves 2007, 44 billion. 2020, 1.7 trillion, a lot more. When we look at corporate profits, 0.7 trillion back in 2001. Corporate profits 2019, 3 times higher, 2.1 trillion. Look at cash on the balance sheets, 2001, just 0.2 trillion. Today, 1.3 trillion. So about 6 times more cash on hand at balance sheets. Very, very strong. So let's summarize it. 2008, what did we have? We had definitely speculation on all sorts of real estate, commercial and residential. Properties were over leveraged. People that shouldn't be buying assets were buying assets, qualifying for loans they couldn't afford. Very risky financial products. So what happened? Well, the Federal Reserve, they didn't jump in near like we're seeing now. They did inject some capital into banks, but that really helped kind of put a ground floor on the financial system. You'll see kind of a Wall Street approach favored versus a Main Street approach. And then when we look at the recovery, it was a slow, long recovery. It took a long time to heal the system. Now let's look at where we're at today. 2008, massive fall by the S&P. And really what's important is that downturn of the Great Recession was really caused by fundamental flaws inside the real estate market, particularly the mortgage market and financing. So financing on the real estate side led to the real estate market to collapse. It was inherent. It was within the real estate segment. In my opinion, when we look at 2020, we now have an external event that's outside of the real estate industry that created a financial downturn, which has now affected businesses, which now is cascaded down and affecting real estate. My opinion, we're looking at something that's much closer to what happened in the early 2000s, right after 9/11, not something like a long, drawn-out downturn like we had in 2008. And by the way, if you note there, real estate did pretty well after 9/11. Real estate tended to recover fairly quickly. So here's where we're at today. strong corporate balance sheets, banks well capitalized, households not carrying nearly as much debt as they did back in 2008. We've got this out of nowhere. We know where it came from. It came from China. We have this COVID-19 pandemic that came in. And what's it done? Well, it's has all of us working at home. And now we've got massive job losses. We've got people losing jobs right and left, companies cutting back, salary reductions. Last I saw a few days ago, it's something like a quarter of the companies have laid off employees. But look at the bottom bullet point. The government has stepped up and the Federal Reserve have stepped up right away and in very, very significant ways to try and turn things around. Let me just wrap up with just a quick snapshot. I think this will be interesting for you, just comparing stocks and real estate. Stocks, total return last year, about 25%, a little over. Then the S&P falls just last month. Total return with stocks over the last 20 years has been about 115%. Real estate, average return about 7%. But look at the total return over 20 years, 359%. So this, I think, is going to draw more capital into real estate. Real estate historically has outperformed the stock market as an asset class. Now, we got something with the stimulus, and this is important. These are some new benefits that really benefit commercial real estate in particular. We've got the cap. There used to be $500,000 on a tax deduction for real estate depreciation, lifted for non-corporate taxpayers. We now have additional losses on depreciation over certain thresholds for single filers and married filing jointly. Third bullet point down is going to be very favorable. The former deductible business interest, which is only at 30%, has now been bumped up to 50% for both last year, 2019, and this year, 2020. We also have the ability now to do a 5-year carryback of net operating losses for businesses. And then the very last one is something that really was kind of a mistake with the Tax Cut and Jobs Act. So that was tax reform at the end of 2017. There was really a drafting error that has been kind of persisting where what is known as qualified improvement property, it was depreciated over a much longer time horizon. This was not intended by those that were drafting the Tax Cut and Jobs Act. As part of the stimulus, now this has changed, and now you can depreciate those over just 15 years, and the benefit is you're now eligible for bonus depreciation. So this is going to help commercial real estate investors and businesses significantly because they're going to pick up a tax advantage that really they had lost for the last few years just by a drafting mistake, unfortunately. So let me give you some quick charts and kind of rapid fire, and maybe this will give you a little comfort looking at the big picture. 2020 is not 2008. This is the historical data for the Mortgage Credit Availability Index. Look at it's been relatively very consistent from 2008, 2009 on. You can see where the housing bubble went. Look at home appreciation. We had right up to the housing crash of 2008, we had huge appreciation. In fact, things were really just on fire everywhere. Look at the last 6 years, fairly modest, somewhere between 4 to 6%, let's say maybe 5% on average. Compare that to years before the big Great Recession. We had some years with 12%. You know, that's just significant. Look at inventory. Supply and demand influence prices. With the Great Recession, we had over 8 months of inventory. Today, we're sitting with just a little over 3 months. So most economists would tell you that 6 months is historically looked at as being a market that's fundamentally in balance. We've just got a good balance between supply and demand. We're running half of that today. Now, that number may change over the next couple months, but we're not going into the downturn with as much excess inventory as we've had. Price of a median priced home. 2006, you needed over 25% of income to qualify. Today, just 15%. And then the last one, when we look at equity that people take out through a refinance, look at 2005 through 2007, $824 billion pulled out of houses. Mm-hmm. Now look at where we are today, 2017 through 2019, just $232 billion. So we don't have people using their real estate assets as a personal piggy bank to necessarily go back and refi, and maybe that was spent on consumption or maybe other investments. the factors that we had happening back prior to 2008, in my opinion, we don't have the same things that are going on. Well, what do we have for recovery? You hear people talk about V or U-shaped recovery. I personally think it's looking a little bit more like a U-shaped recovery at this point in time. But I'm not sure it really matters as long as we do recover after this initial shock. I know the president is certainly very concerned to get the economy working again, and it's a tough balance. Weighing the health considerations and slowing the spread of the virus versus getting the economy going, and I think that's constantly being reassessed. Even now, I think he just brought a task force on of experts, leaders of different industries to help do that. So I say the underlying demand is high, and even though we've had this short downturn, the fundamentals are in place. Certainly, this will be tempered by the ability to obtain financing capital. So if we don't see those markets go back to where they would normally function, that could be a little bit of overhang and dead weight. But if the financing and capital markets start to function like they have historically, and we start to get loans being made, that will certainly help us to bounce back. Now, what I want to do is switch gears. Let's look at taxes and 1031 exchanges. So when we look at taxation today and going ahead, boy, particularly when we look at 1031 exchanges, we've got some interesting things ahead. Right now in the tax plan, former Vice President Joe Biden, he's the presumed Democrat nominee, he has a plan in place to accomplish certain things, but that right now includes eliminating 1031 exchanges. So that is certainly a concern for those of us in the real estate industry, and particularly the qualified intermediary industry. An individual, Wyden, who's on the Senate Finance Committee, he's come out with a white paper and a very unusual proposition, which is taxing people on their gains before they actually dispose of an asset. So yearly being taxed on the deferred gain. It's called a mark-to-market type thing, and that happens in other segments. But doing that for an individual taxpayer, this has never been contemplated. It would be, in my opinion, very, very, well, it'd be hard to value assets, but to force taxpayers to pay taxes on a gain when they don't actually have the cash, I think there just are a whole bunch of challenges. But here's the takeaway. We have a lot of proposals right now to potentially increase capital gain taxes, maybe take income taxes up, maybe take capital gain taxes up to income. Some people that were running for president, Elizabeth Warren and Bernie Sanders, had proposed a wealth tax, taxing those at the very top more and increasing that tax rate to generate revenue. I think the thing we want to look out for is if we run into a situation where all three branches of government, so the House, the Senate, and the executive branch, if they swing where it's all one party or the other, the likelihood of having significant changes in tax rates goes up a lot. That's the big risk. And I would tell you today, I don't think anybody knows what's going to happen in November, where things are going to land. I've seen some polling showing Joe Biden polling ahead of President Trump. So I've certainly seen that. Some of it right now, it's a wild card. When you're in a bad economy, that doesn't typically bode well for the incumbent. Who knows where the economy's at in November? It's going to be, anybody's guess to know that. So I think that's something to keep in mind. If power swings to all one party or the other, I think there's a higher likelihood that there's significant tax reform. Last point, very important. It's not something we can deal with now, but how are we as a country going to pay for all this stimulus? We took on literally trillions and trillions of debt, and we've got all sorts of burdens now where we're doing that. Somewhere, we're going to have to pay for that. In my opinion, that means down the road, tax rates are going to have to go up. That's the only way to do that. Speaking of taxes, getting close to the 1031 topic, when an investor that owns investment property, when they sell, they face potentially 4 different levels of taxation. They've got taxes on the depreciation recapture at a rate of 25%. Then the remaining gain is taxed under the federal tax rates of either 15 or 20%, depending upon the taxable income. So higher earners at that 20%, who's selling commercial properties, investments 20%. Then a lot of people face this additional, what we call a net investment income tax, 3.8%. And that's over certain thresholds, 200,000 for single filers, 250,000 of net investment income, married filing jointly. So that'll be an additional tax that's there. And again, on the commercial market, most everybody's going to face that in some form or the other. And then finally, we've got the state tax rate. So some people have no state taxes. Wyoming, just north of me. Florida, Texas, where Stewart Title, our parent company, is based, zero tax rate. But some states have very significant state taxes. The highest in the country that I'm aware of is in California. The maximum state tax rate is 13.3%. So, and if an investor doesn't do a 1031 exchange where they're going to defer capital gain taxes, right, push that into the future, they then are facing potentially all four levels of taxes. And you got to add that up. And the end of the day, we find as qualified intermediaries, many real estate investors are very surprised at what they'll face in total taxes when they add up all four levels of taxation. So speaking of 1031, we've got time deadlines. I think most are familiar with them. When you do a 1031 exchange, you close. You have what's called the identification period, which ends at midnight of the 45th day. We call that identification or ID period. You have what's called the exchange period, which is a maximum, generally, of 180 days. So it's 45 calendar days plus another 135 days for a maximum of 180 days to complete the exchange. Now, you'll see the caveat. If you've got a situation where they file their tax return, it's the earlier of the year, the transfer of the relinquished property, whichever is earlier. But let's switch into what's really important. We got some good news. April 9th, the IRS issued what we call Notice 2020-23. And by the way, just so you know, the 1031 exchange industry, we knew this was an issue. There are people on the Federation of Exchange Accommodators, our National Trade Association. We have a government affairs committee. There were a handful of people that worked very, very hard trying to get this guidance, working in conjunction with other real estate organizations nationally. There were a lot of efforts made to get guidance because a lot of our clients wanted to know, what do we do? They can't get out, they're shelter in place, they can't do due diligence on replacement property. Things got very complicated here in the last 3, 4, 5 weeks. So this notice now extended certain time deadlines for what we call an affected taxpayer. And this included 1031 exchange investors. Now, to be honest, this notice covered a whole range of issues, but it happened to include what's important to our customers, 1031 exchange investors. So it defines somebody and came up with the definition of who is what's called an affected taxpayer. And then it went ahead and it provided longer time deadlines. So let me walk through what those are. If the end of the taxpayer's 45-day identification period or their 180-day exchange period in either a deferred exchange, so that's what we call a forward exchange, or what's known as a parking arrangement transaction, known as a reverse exchange under Rev Proc 2000-37. If this 45 or 180 days falls between April 1st, 2020 and or up to July 15th, 2020, then the period is automatically extended to July 15, 2020, unless the taxpayer desires to opt out of this. So they can do that. They have the ability to do that. And certainly what they would want to do is contact their qualified intermediary if that's what they want to do. So if your time period falls between April 1st to July 15th, on your 45 days, it's extended out, so you get much longer. If your 180 days exchange period fell in there, it's going to be extended out all the way till July 15th. So this is pretty good. Let me show you a couple of examples. If somebody closes on a property on April 5th, their normal 45th day would be May 21st, 45 days out. This is now extended to July 15th. So they get a longer time period for their identification period. However, their time to close on the exchange is still the 180 days. So they've got to close on their property before October 3rd in this example. So they get a little extension. The next example down, somebody closed on a property way back in January, and their 45th day happened to be, so January 16th is when they closed. 45 days was March 1st. They don't get an extension on their identification period. Thanks for letting me know that, Martin. They don't get an extension on their time period for their identification. They do get an extension on their 180-day exchange period. So if their 180-day, in this case happened to be July 14th, they pick up one more day, would go back to July 15th. Now, this is the good news. We got some clarity. Unfortunately, we didn't get as much as we wanted. Only deadlines, the 45 and 180-day deadlines that fall between April 1st through July 15th are extended. This notice doesn't address things that happen after July 15th, nor things that happen before it. And what's a little unusual with this particular notice is that normally in a disaster relief notice, we get some clarity on some issues, and this one was written a little bit differently. I'm not sure anybody knows exactly why. I suspect it's because the IRS and the Treasury have their hands full. They've got an economy in free fall, and so they did the best they could to get some guidance out to a whole bunch of different taxpayers, but it maybe wasn't quite as comprehensive or thorough. One thing that happens a lot of times in a disaster relief notice is there is a reference to a particular part. So they reference back to Section 17 of what's known as Red Proc 2018-58. And this provides an automatic 120-day extension. This reference wasn't included in Notice 2020-23. Therefore, the conservative interpretation is that we don't have that. I know there are a few people that would like to believe that maybe we do have it. There's some debate on a particular issue that's out there, but the conservative approach would be to realize that since that wasn't explicitly provided for, by default, it's probably not provided for in this particular notice. We also have people that wanted some input. This declaration happened for April 1st going forward to July 15th. We have a lot, hundreds and thousands of taxpayers, frankly, around the country that faced a situation where they closed, much earlier. Some would like the guidance to go all the way back to March when the original declaration was made, the FEMA and Stafford Act. Some would like it to go back all the way to January 20th when the original FEMA disaster declaration was made. Input today, stick with what we know. Make decisions based upon known guidance. Now, the one caveat to that, we just found out a few days ago, the IRS is aware that we've got concerns related to Section 1031 exchanges, and they said that they're going to provide some guidance. We don't know what that'll look like, but apparently they know there's some of these issues, and they're going to provide guidance. So today, on April 16th, this is what we know. That could very well change in the next few weeks. And I know that's difficult for you and your customers. You've got to operate in an environment where you've got a little bit of guidance, but not all issues answered. And I think the approach is just to work with what we know for sure now. Finally, what I want to do is just do a quick compare and contrast. Something known, I refer to it as OZ, it's a qualified opportunity zone. We get lots of questions on this compared to a 1031 exchange. So a qualified opportunity zone provides certain tax advantages on deferred gain that's reinvested into this opportunity zone. And then it provides some really nice tax advantages on new gain when property is held onto for 10 years or more. So some people don't know what to do there. Can they combine a 1031 with that or not? So let me just quickly summarize what's possible. One strategy, an investor can start off setting up a 1031 exchange. Because these are completely different provisions, if the investor doesn't find property that they like for their 1031 exchange, they can notify the qualified intermediary that they haven't identified any property. Therefore, they can't complete the 1031 exchange because they haven't identified anything. The qualified intermediary, after the end of the identification period, which would be on day 46, releases the money back to the investor. Then the investor can take those proceeds and go invest into a qualified opportunity zone. Normally, they've got another 135 days to invest. They also, in the opportunity zone, got an extension, just like we did with Section 1031 exchanges. So they also picked that up. One benefit of the opportunity zone, and I think some people are aware of it, but maybe not everybody, when an investment is made, you only need to invest the gain into the opportunity zone fund, only the gain. When you set up a 1031 exchange and desire full tax deferral, you need to reinvest the entire net equity and have the same or greater amount of debt on the replacement property compared to the relinquished property to obtain full tax deferral. So a little bit more flexibility there. Another thing you can do an exchange and have it an entity. So it can't be a disregarded entity, but it can be a regarded partnership corporation that completes a 1031 exchange. So they do a valid 1031 completed. After the exchange is over, you can now bring in new capital. If they exchanged into an opportunity zone, one of those designated areas, and each state has that, they bring in new funds, maybe syndicated funds, improve that property. So what they end up with is they've got the deferred gain in a 1031 exchange that's been deferred, and then they've got the benefit of that new capital coming in that came in through, let's say, a syndicated fund where they get the opportunity zone treatment. Finally, one last thing that can be done. You can sell a property and you can either invest in a 1031 or an opportunity zone fund, or you do a little bit of both and you allocate some of the money into a 1031 exchange and some into an opportunity zone fund. Now, I've got a whole separate class that goes into opportunity zones. You certainly want to check with your CPA. I think personally, for people that sell assets that have had gain, businesses, personal property, things like that, an opportunity zone has a lot of advantages. My personal opinion, a lot of times when it's real estate, I think there are significant benefits to a 1031 exchange if they're going to invest in other like-kind real property. But again, everybody's kind of has to assess their particular situation. What doesn't qualify? You can't do a 1031 exchange directly into an opportunity zone fund. Pretty straightforward. 1031 exchange has to be like-kind real property exchanged for like-kind real property, and the fund is not. The other one, and this is a little tricky, you can't necessarily identify multiple replacement properties, purchase, let's say, one of those, and have others identified outside of the identification period, then get the money back and necessarily go into an opportunity zone fund. There's something called G6, which limits the taxpayer's rights to receive, borrow, otherwise obtain the benefit of money or other property in an exchange. Now, this is a little more complicated because certain partnerships and LLCs do have longer time periods where they could potentially qualify. Anyway, I just wanted to briefly touch upon that. Hopefully, been able to cover some good ground. We will be sure to get out a copy of this presentation, a PDF, so you've got a reference on it. If you're looking for more information, asset preservation's on various social media, so you see where we are on YouTube, Facebook, LinkedIn, and Twitter. And finally, at Asset Preservation, we field all sorts of questions related to capital gain, 1031 exchanges. We spend most of our time talking about things that can be done. We have a lot of expertise doing that. We have a whole commercial division that does nothing but commercial transactions. We have a lot of expertise. We, as an intermediary, QI, we can't provide tax or legal advice. With that being said, we can give a whole lot of input. So feel free to call us and discuss your specific 1031 exchange scenario or kick around ideas. Our national headquarters is just outside of Sacramento in Roseville. Phone number is 800-282-1031. We have an office in New York, and I know New York's been just really, really hit hard in the city with the COVID-19 virus. Our office there is on Long Island, 866-394-1031. And finally, our website, apiexchange.com, has a lot of information. Feel free to check it out. And if you have specific questions and you're outside of normal business hours, feel free to email us at info@apiexchange.com. That's monitored by senior management. And we do a lot of inquiries by email, and we're all communicating that way. I want to thank you for your time. Hopefully you got some good insights and perspectives on this. And thank you very much. And feel free to call us anytime at Asset Preservation with your 1031 exchange questions.